What if I told you that a company, a real behemoth in the beverage world, is like a perfect storm of rock-solid fundamentals and some pretty significant external risks?
Wow.
Well, today, we're taking a deep dive, just for you, into exactly that company.
Sounds intriguing.
Our mission. We've gathered a whole stack of sources on Ambev SA, that's ABEV3 in Brazil, ABEV on the NYSE. And our goal is to pull out the most important bits, the key insights really, to give you a shortcut to being genuinely well-informed about this fascinating company.
Getting right to the good stuff.
Exactly. Now, all the info we're discussing is current as of July 18, 2025. Just so you know, right now, Ambev's trading at R13.46 on the BVMF, that's ABEV3, and US $2.42 on the NYSE as ABEV.
Got it.
We've broken this whole thing down into 7 chapters for you. Part 1 will tackle Ambev's core business, who's running the show, and their financial health.
The fundamentals.
Right. Then in Part 2, we'll shift focus market sentiment, ownership, the big risks, and then we'll wrap it all up with a synthesized conclusion on the investment thesis.
A comprehensive look then.
Okay, let's unpack this. When we think about any company, you got to start at the beginning. What exactly does Ambev do? What's fueling this enduring enterprise?
Chapter 1, The Business of Thirst. Understanding Ambev's enduring enterprise.
Okay.
So the big question we're really digging into here is this. Can this, century-old beverage giant, deeply rooted in Latin America's sometimes volatile markets, can it keep quenching investor thirst for stable, long-term returns?
Especially now, right, with tastes changing and all those economic headwinds.
Exactly. We're focusing on Ambev SA, trading as ABEV3 on the B3 in Brazil and as ABEV, the ADR, on the NYSE. Our objective today is a full fundamental analysis. We're dissecting the business model, competitive position, management quality, financial health, all to get a sense of its intrinsic value, following those long-term value investing principles.
And just to remind everyone, the analysis date is July 18, 2025. You called Ambev's business model elegantly simple, yet immensely powerful. That sounds interesting. Can you unpack what makes it both? Especially their product strategy. You called it a masterclass.
Absolutely. When we say elegantly simple, it's because at its core, they produce, distribute, and sell beverages. Beer, mainly, but also soft drinks, CSDs, and other non-alcoholic stuff.
Right.
The immensely powerful part comes from how they do it. Their geographic footprint is key. Brazil is huge for them, but also Central America, the Caribbean, Latin America South, think Argentina and Canada.
And the product strategy, the masterclass part.
Ah, yes. It's a brilliant dual approach.
Right.
They've got their own massive portfolio of beer brands. That's the core profit engine. Think Skol, Brahma, Antarctica.
Local giants?
Exactly. The local champions. Sukla and Brahma are like top 10 globally consumed beers, huge cultural roots there, and also Quilmes in Argentina. These are the bedrock.
Okay, and the other part of the approach?
Then they have a really strategic partnership with PepsiCo. This gives them exclusive rights for Pepsi, Gatorade, Lipton iced tea in Brazil, and other key Latin American markets.
Ah, so they cover both bases, beer, and soft drinks.
Precisely. The goal is to capture a wider share of throat, as they say, be the drink for any occasion. They also have their own non-alcoholic brands like Guaraná Antarctica, huge in Brazil, plus water, energy drinks like Fusion, juices.
So that diversity helps them navigate shifting tastes.
Absolutely. If people drink less beer one year, maybe they buy more Gatorade or Guaraná. It provides resilience. And then layered on top of the local champions are the global brands.
Like Budweiser, Stella Artois.
Right. Licensed from the parent, AB InBev. That's their premiumization play, tapping into that drink less but better trend. It's really a masterclass in covering all segments.
And what about getting all these drinks to the customer? I heard their distribution system is a big deal.
Oh, it's absolutely critical. Especially in Brazil, their direct distribution system handles something like 75% of their total volume. Yeah. And this isn't just trucks and warehouses. It gives them immense control over the supply chain, ensures their products are everywhere, and lets them maintain direct ties with millions of bars, restaurants, shops. It's a logistical powerhouse.
Ambev's scale is just... Well, it's difficult to overstate, isn't it? They dominate something like 60% of Brazil's beer market and serve 300 million people.
The numbers are staggering. Largest brewer in Latin America, one of the biggest globally. Market share is dominant not just in Brazil, but over 65% in Argentina, El Salvador, Uruguay. 70% in Bolivia.
And that scale isn't just bragging rights. Rather,
Yeah.
it translates to real strategic power.
Exactly. It gives them huge operational leverage, a deep incumbency advantage. They can invest, absorb shocks. It's like a gravitational pull, as you said.
So for the consumer, the value prop is basically trusted brands, always available.
Yep, wide array, high quality, everywhere.
And for the retailers.
A reliable one-stop shop for drinks people want, and increasingly they're supporting that with digital tools like the BMEAT's platform to make ordering easier.
All right, we'll touch on BOs later. And their mission.
Their stated mission is uniting people for a better world.
Okay. Let's shift to the broader industry then. What are the big trends shaping the Latin American beverage market right now?
It's a fascinating landscape. 3 key trends really stand out. First, premiumization. We touched on it, that drink less but better idea. It's driving growth for higher margin global brands like Corona and Stella.
Makes sense.
Second, health and wellness. This is huge. It's fueling demand for things like functional drinks, added vitamins, that sort of thing, low or no alcohol beers, cleaner labels. Get this, 74% of Mexican consumers apparently drink functional waters weekly.
Wow, that's a big number.
It really is. And third, the rise of craft beer. It's still smaller, but growing incredibly fast in places like Brazil, 565% growth between 2015 and 2020. Shows a real appetite for unique flavors.
So what's the overall market outlook then? Stable? Growing?
Overall, pretty stable long-term. Soft drinks are expected to be the biggest segment by 2030, but spirits might see the fastest growth. For beer specifically in Brazil, projections are around a 5.9% compound annual growth rate between 2025 and 2035, so decent growth there.
So even with Ambev being so dominant, who are they actually competing against day to day?
Oh, it's definitely intense. In Brazil, the main rivals are the global giant Heineken and a strong local player, Grupo Petrópolis. Ambev's market share is more than double its nearest competitor, but the fight is real, especially in that premium segment.
And the craft brewers you mentioned.
Yeah, they add another layer. It's fragmented. But they're definitely chipping away, especially with consumers looking for novelty. So while Ambev leads, they certainly can't rest on their laurels.
And operating in Latin America,
Yeah.
the regulations must be tricky.
Tricky is an understatement. It's often highly complex, sometimes burdensome. You're dealing with high, often unpredictable excise taxes on alcohol, on sugary drinks, plus marketing restrictions, labeling rules, environmental regulations on water, emissions, packaging.
It sounds like a headache.
It is. It actually acts as a barrier for new companies trying to enter, but it's also a constant risk for established players like Ambev. They have teams just managing this stuff.
Okay, this is where it gets really interesting for me. Those barriers to entry. You mentioned they create Ambev's wide economic moat. What exactly makes it so hard for someone else to challenge them?
That's the core of it, isn't it? The moat. It's built on several things. First, just the sheer capital intensity. Building breweries, bottling plants, distribution centers. You need billions upfront.
Okay, so money is one barrier.
A big one. Second is brand loyalty. Ambev's core brands have been around for generations, some over a century. You can't just create that kind of deep cultural connection overnight. Skol and Brahma are institutions.
True. Hard to displace those.
Very. But arguably the biggest, most difficult barrier to replicate is their distribution network. This vast, incredibly sophisticated, highly efficient machine reaches millions of points of sale. Getting your product reliably into every corner store, every remote bar, that's something Ambev has perfected over decades. A new player simply can't match that reach quickly, if ever.
So that network is really the jewel in the crown.
Many would argue it is. It ensures that ubiquitous presence we talked about.
Speaking of that moat, let's break down those competitive advantages a bit more. Brand strength is clearly one.
Absolutely. Brand strength and recognition is premier. It's that powerful mix. The iconic local heritage brands, Skol, Brahma, Quilmes, combined with the aspirational global names like Corona, Budweiser, Stella Artois. This mix creates deep loyalty and gives them real pricing power.
And the cost advantages. You mentioned scale earlier. Ambev's colossal scale must be the engine here.
It absolutely is. That dominance allows for immense leverage on their fixed costs, breweries, distribution centers. They get better prices on everything, barley, hops, aluminum cans, because they buy so much.
Better procurement power.
Exactly. And this gets amplified by that legacy from 3G Capital, that intense focus on operational discipline, rigorous cost management. It's a huge reason why they've been able to consistently expand their EBITDA margins.
So it creates a kind of positive feedback loop.
Precisely. A virtuous cycle. Dominant market share leads to economies of scale, which gives a cost advantage. That advantage funds marketing and investment to defend or grow share, which reinforces the scale. It's hard to break that cycle.
But does being that big make them a target for regulators? We touched on that.
It definitely does. That's the flip side of dominance. They're always under scrutiny for potential antitrust issues or being the obvious target for new taxes. It's a constant balancing act. But the scale advantage is undeniable.
And I heard they're building a digital moat now, too, with something called bees. What's that all about? Is it like a network effect?
Yes, that's a great way to put it. They're building a powerful digital moat with their B2B platform, BEs. The growth has been phenomenal. Gross merchandise volume surged 60%.
60%? Wow. How does it work?
It directly connects retailers, bars, shops to Ambev. They can order, pay, manage deliveries all through the platform. As more retailers join, it becomes more valuable for everyone, creating really high switching costs. Why would a retailer go back to phone calls and paper forms?
Makes sense. Sticky.
Very sticky. And critically, it gives Ambev real-time sales data down to the individual store level. This lets them optimize their supply chain, manage inventory incredibly precisely, and even push specific high-margin products. It turns them from just a supplier into an indispensable business partner.
It's almost like they've built the Amazon Prime of beverages for Latin American retailers, hasn't it?
Yeah.
A logistical and data advantage rolled into one.
That's a good analogy.
Yeah.
And it reinforces that other key asset.
The physical distribution network.
Exactly. Ambev's single most valuable and probably inimitable asset remains that physical network. Hundreds of distribution centers, a massive fleet. It ensures that deep market penetration, that crucial last-mile delivery. It's the absolute cornerstone of their dominance, and Ambev product is always within reach.
Incredible. Okay, before we move on to the people running this empire, just a quick reminder for you listening.
Wow.
If you're finding this deep dive valuable, please do hit like and subscribe to the Stock Analytics AI YouTube channel.
Yeah, it really helps us out.
It does. And members, for just $4.99 a month, you can suggest stocks for future deep dives in the comments. We do pick them up. Plus, you get priority access. We're actually covering all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those.
That's a lot of deep dives.
It is. And if you just want a one-off deep dive on a specific company, just drop us a super thanks. Okay, let's move on. Now that we really get the business, let's talk about the people steering this massive ship. Who are the stewards of capital here?
Chapter 2, Management Evaluation, the Stewards of Capital.
Right.
Well, Ambev is led by CEO Jean Gersati. He heads up a team that's really steeped in a culture of meritocracy and operational excellence. This comes directly from the philosophy of the 3G Capital founders,
Yeah.
Lemon, Tellez, Secapura.
That famous 3G discipline. Cost control, efficiency.
Exactly. Discipline, cost control, efficiency, but also that idea of dreaming big. It's still very much part of their DNA.
And what's the track record look like? How do we know they're actually effective?
Well, the results speak for themselves in many ways. We've seen 10 straight quarters of margin expansion through the first quarter of 2025, and that's despite serious inflation and market volatility.
Impressive.
It is. Plus, think about managing huge, complex events like Brazil's Carnival, a logistical feat. And their history shows they're good at integrating large acquisitions. Even though the focus now is more organic, it points to a very capable team. They execute.
What about transparency and ethics? How do they communicate with investors?
They maintain a pretty comprehensive investor relations website. You'll find quarterly reports, SEC filings, the annual Form 20F. They state their core principles include upholding strong ethics and transparency.
Okay. But it's worth noting, for context, that the parent company, AB InBev, did have that SEC fine back in 2016 related to issues in India, right?
That's correct. AB InBev paid a $6 million fine for FCPA violations in India and for silencing a whistleblower. It's important context, part of the broader corporate history, even though it didn't directly involve Ambev's current management team.
Good to know. So, shifting to how they use their money capital allocation, you mentioned Morningstar gives them an exemplary rating.
Yes, Morningstar rates their capital allocation as exemplary, which is their highest rating. Historically, a lot of Ambev's growth came from those big M&A deals, Brahma and Antarctica merging, buying Kinza in Argentina, the Labatt deal leading into AB InBev.
Transformative stuff.
Absolutely. But the current focus seems to be more on organic growth. They're strategically reinvesting in the business, pushing premium brands, building out that BES digital platform. The goal now is enhancing profitability and strengthening that moat from within.
And how do they return cash to shareholders? Dividends? Buybacks?
They do both. They use share repurchase programs, for instance. They approved a new one in October 2024 to buy back up to about 155 million shares by April 2026. That often signals management thinks the stock is undervalued.
And dividends.
Oh, yeah.
Yeah.
They have a very generous dividend policy. Their corporate bylaws actually mandate a minimum payout of 40% of adjusted annual net income.
40% minimum. That's quite high.
It is, and
Yeah.
they have a long, consistent history of paying dividends, often using a structure called interest on shareholders' equity in Brazil, which has tax advantages. The yield has been pretty attractive, somewhere between 3.6% and 8.4%.
So that brings up the efficiency question again. How well are they actually using the capital they keep in the business? Let's talk return on invested capital, ROIC. What do the numbers show?
ROIC. This is where Ambev really shines. They are a stellar performer.
How stellar.
Well, their normalized ROIC is reported around 16.37%, maybe 14.80%, depending on the calculation, but significantly higher than their cost of capital. And compare that to a major peer like Heineken, which is around 7.78%.
Wow, so more than double Heineken's ROIC.
Pretty much. It shows that for every dollar they reinvest in the business, they generate exceptional returns. And this isn't just a one-off. Look at the trend. 14.7% in 2020, over 16% in 2021, nearly 19% in 2022, over 20% in 2023, and still strong at 14.5% in 2024.
That's consistently impressive.
It really is. It highlights the durability of those competitive advantages we talked about and just how effectively management allocates capital.
Yeah.
It's a sign of a high-quality, well-run business.
Okay, strong management, smart capital use. Let's peel back another layer and look at the raw numbers underpinning everything. What does the financial bedrock look like?
Chapter 3, Financial Analysis. A deep dive into the financial bedrock.
Let's dive in.
First off, just scale again.
Yeah.
Market cap around $209 billion, or roughly US $38 billion. Definitely one of the giants in Brazil.
And revenue growth. Has the top line been moving up?
Yes, consistent top-line growth over the last 5 years, even with all the economic ups and downs. Net revenue went from about $58 billion in 2020 up to nearly $90 billion in 2024.
What's driving that? Volume? Price?
It's a mix. Volume growth, smart pricing actions, and that ongoing push towards more premium, higher-priced products.
Okay. And profitability? What are the margins telling us?
The margins are really robust. For fiscal 2024, gross profit margin was over 51%. Operating profit margin was strong at 24.4%, and net profit margin came in at 16.1%.
Those are healthy numbers. Indicates pricing power and cost control.
Absolutely. It shows they can command decent prices, and they're very good at managing their costs again, that 3G influence.
And the bottom line for many investors? Free cash flow.
Yes, FCF. For value investors, this is often the ultimate measure, and Ambev is, frankly, exceptional here. They consistently generate substantial and growing free cash flow.
How much are we talking?
It grew from about $14 billion in 2020 to over $21 billion in 2024. That huge FCF generation is what fuels the dividends, the buybacks, and gives them incredible financial flexibility.
Beyond profits and cash flow, how stable does the overall financial picture look? Are earnings consistent?
Remarkably so. Their net income has been impressively stable, hovering between $11 billion and $14.5 billion over the last 5 years. It really shows the defensive nature of the business people still buy beer and soda even when times are tough.
And debt, are they leveraged up or more conservative?
Extremely conservative. Their balance sheet is exceptionally strong, minimal debt. The debt-to-equity ratio recently was just 0.03.
0.03, that's tiny.
It's tiny. It's been falling, too, down from 0.06 in 2020. They actually operate with a substantial net cash position. They have almost $30 billion in cash and short-term investments versus only about $3.5 billion in total debt.
So they could pay off all their debt many times over with the cash they have on hand.
Easily. They're sitting on a mountain of cash. It gives them enormous resilience.
And their ability to cover short-term bills.
Liquidity.
Also very healthy.
Yeah.
Their current ratio is 1.11, so more than enough liquid assets to cover near-term obligations. Very sound financially.
We mentioned the dividends earlier, but just to circle back, they're stable and growing. Yes, a well-established track record, reliable payer, that minimum 40% payout policy, resulting in that substantial yield we discussed, between 3.6% and 6.4%. Consistent income stream for shareholders.
Okay, putting all these strong numbers together, how does the valuation look right now? Is the market recognizing this strength, Or is it maybe overlooking it? How does it stack up against peers or its own history?
That's the million-dollar question, isn't it? On a relative basis, Ambev looks, well, pretty reasonably valued. Its trailing PE ratio is around 14.7x.
How does that compare?
It's roughly in line with, maybe slightly better than, Heineken at 15.4x. And it looks way more attractive than Fomento Económico Mexicano, FMX, which trades at a very high PE of over 107x.
But maybe a premium to the broader sector.
It does trade at a premium to the average consumer non-cyclicals PE of about 12.1x, but you could argue that's justified by its much higher profitability and market dominance. Look at price to sales. Ambev's around 2.3x, the sector average is only 0.9x.
You're paying more but getting more quality.
That's the argument. And importantly, it also looks attractive compared to its own historical valuation range. So you're getting that superior capital efficiency, that high ROIC we talked about, at a valuation that doesn't seem excessive historically.
How do we move beyond relative valuation to figure out what the business itself might be worth? Intrinsic value. Can you quickly explain that concept?
Sure. Intrinsic valuation, often using a discounted cash flow or DCF model, is really the cornerstone for many value investors. The basic idea is that a company's true worth is the sum of all the cash it's expected to generate in the future, but discounted back to what that cash is worth today.
Because a dollar tomorrow is worth less than a dollar today.
Exactly. So you need to make assumptions about future growth, about profitability, and importantly, about the right discount rate to use to bring those future cash flows back to the present.
Okay. So based on a conservative educational DCF model, what kind of intrinsic value range are we looking at for Ambev? And what are the key assumptions behind that estimate?
Well, first, many analysts seem to agree that Ambev looks discounted right now. Morningstar, for instance, puts the discount at around 24–25% below their fair value estimate.
Interesting. And your model?
Based on a conservative, purely educational DCF model, the estimated intrinsic value range for the NYSE-listed ADR, ABE, comes out somewhere between US $2.80 and US $3.20 per share.
Okay, $2.80 to $3.20. Compared to the current price, around $2.42, that suggests potential upside.
It does suggest it might be undervalued based on these assumptions. Now, the key assumptions driving that are, first, a perpetual growth rate for free cash flows beyond the explicit forecast period of 2.5%.
Why 2.5%?
It's meant to be conservative, slightly above long-term global inflation, but likely below the long-term GDP growth you might expect in Latin America.
Okay, and the discount rate?
We used a weighted average cost of capital, or WACC, of 9.0%. This tries to balance the risks of operating in Latin America against Ambev's stable cash flows, dominant market position, and that super strong balance sheet.
Got it. So, strong fundamentals, potentially undervalued.
Yeah.
Let's transition now. We've looked inside the company, now let's zoom out. How is the market actually perceiving all this? What's the mood out there?
Chapter 4, Market Sentiment. Gauging the market's mood.
What's Wall Street saying? Buy, sell, hold.
The prevailing Wall Street consensus right now is generally a hold. If you look at price targets for ABEV on the NYSE, the average is somewhere between US $2.60 and $2.93. But the range is quite wide, from a low of $2.15 up to a high of $4.
A big range. What about the local shares, ABEV3?
Similar story. Average target for ABEV3 in Brazil is around R$13.70 to R$14.78, with lows around R$10 and highs up to R$17.
Have there been recent changes in ratings?
Yes, there have been some shifts. Earlier in 2025, firms like UBS, Morgan Stanley, and Citigroup actually downgraded their ratings, often from buy to neutral or even underweight.
Why the downgrades? Problems with the company?
Interestingly, no. The drivers cited were mainly those macroeconomic concerns we've touched on, the external environment, rather than specific operational issues at Ambev itself.
Okay, so analyst sentiment is cautious due to macro factors. What about the general media narrative? Is it positive, negative, mixed?
It's definitely mixed. On the one hand, you see positive coverage highlighting their strong Q1 2025 results, double-digit bottom-line growth, decent revenue increase, those expanding margins thanks to cost control and premiumization.
The internal strengths.
Right. But then the negative side focuses heavily on the challenging external stuff. The volatile foreign exchange rates, rising commodity costs, especially things priced in US dollars, and worries about consumer spending weakening in Brazil because of inflation and high interest rates. It's a real tug-of-war in the headlines.
There are lots of people betting against the stock then. What does the short interest look like?
That's what's interesting. The short interest is remarkably low.
Really?
Yeah. For ABV on the NYSE, the short interest is around 48 million shares,
Yeah.
but the public float is huge, like 4.5 billion shares. So the short interest is only about 1.06% of the float.
Only 1%. That's so big.
It suggests there isn't strong bearish conviction among traders. Very few people are actively betting that the stock price will go down significantly. That's usually seen as a positive sign.
Okay, interesting. What about technicals? How's the price looking relative to its moving averages? Is it trending up or down?
Right now, ABEV at US $2.42 is trading pretty close to its 50-day simple moving average, which is somewhere between $2.37 and $2.46. That often suggests a period of consolidation where the price is kind of pausing.
But broader indicators.
Broader moving average indicators are actually generating an overall buy signal, which implies some positive short-term momentum might be building.
And the longer-term trend, the 200-day average.
The price at $2.42 is trading above its 200-day simple moving average, which is around $2.41, or maybe $2.23, depending on the source. Technically, that's considered a bullish sign, indicating a positive longer-term trend, despite any recent choppiness.
Okay, so market sentiment is mixed. Analysts are cautious on macro, but short interest is low and technicals look okay to positive. Let's shift gears again. Understanding who actually controls a company is really crucial for investors, isn't it? Let's dig into Ambev's ownership structure. Who holds the reins?
Chapter 5. Ownership structure. Who holds the reins?
Who are the main players here?
The ownership structure at Ambev is, well, highly concentrated. The dominant controlling shareholder is Anheuser-Busch InBev AB, InBev. They indirectly hold about 61.8% of Ambev's total shares and voting stock.
Over 60% held by the parent company. What about the rest, the public float?
The public float is held by a diverse group of institutional investors. They own somewhere around 7.3% to 7.9% of the outstanding shares.
Who are some of these big institutions?
The top holders include names like First Eagle Investment Management, FIL Ltd, Arrow Street Capital, GQG Partners, MFS Investment Management. These are generally sophisticated, long-term oriented investment firms, not typically short-term traders.
Okay, and what about insiders? Do the executives and directors own much stock directly? Are they buying or selling?
Direct ownership by Ambev's own execs isn't clearly detailed in the public filings. Ultimately, control really rests with the parent, AB InBev, which itself is heavily influenced by those 3G Capital founding partners.
And transactions. Any insider buys or sells reported for the ADR?
No reported open market purchases or sales by corporate insiders for the ABEV ABR over the last 12 months, but that's quite common for foreign private issuers, FPIs, because they have different reporting rules than U.S. companies. So a lack of reported transactions doesn't necessarily mean nothing happened.
Okay, so what's fascinating here, as you said, is that high concentration with AB InBev holding nearly 62%. For us minority shareholders, people owning the ADR, the local shares, that sounds like it could be a double-edged sword. What are the pros and cons for the little guy?
That's exactly the right way to think about it. It is a double-edged sword. On the plus side, having a stable, controlling shareholder like AB InBev means a consistent, long-term strategic direction. Ambev also gets access to AB InBev's global resources, its global brands. That's a significant advantage.
Okay, stability and resources. What's the downside?
The potential disadvantage is the risk of conflict of interest. Decisions about capital allocation, like how much cash to reinvest versus how much to pay out as dividends, could potentially be influenced by what's best for the parent company, AB InBev, rather than what solely maximizes value for Ambev's minority shareholders.
So AB InBev might want Ambev to pay bigger dividends to fund its own needs, even if reinvesting that cash in Ambev might offer better returns.
That's the potential conflict, yes. It's a crucial dynamic that minority investors really need to keep an eye on and be aware of.
Right, a key factor to monitor. Okay, moving on. Every business, no matter how strong, faces risks. And for Ambev, operating where it does, navigating that complex landscape is absolutely key. Let's try to get the full picture.
Chapter 6. Risk Assessment. Navigating a complex landscape.
Let's maybe start with a SWOT analysis. Strengths, weaknesses, opportunities, threats. What are the core strengths?
We've covered many already. Dominant market leadership, near monopoly shares in some markets, that powerful brand portfolio, local icons and global stars, the unparalleled distribution network, almost impossible to replicate, proven operational excellence, driving margins, that fortress balance sheet, low debt, net cash, and consistent, strong cash flow generation. These are the internal pillars.
Okay, those are significant strengths, but what about the internal weaknesses? What holds them back?
The biggest weakness is probably the flip side of their dominance, geographic concentration. Being so reliant on Latin America, especially Brazil, makes them very vulnerable to regional economic shocks and political instability.
The dependence is a risk. Anything else?
Yes, that currency mismatch we discussed. Roughly half their cost of goods sold is linked to the US dollar, but revenue is mostly in local currencies like the real. If the real weakens, margins get squeezed. And related to that, limited geographic diversification compared to truly global peers restricts growth avenues outside the Americas.
Okay, so concentration and currency are key weaknesses. What about opportunities? Where can they grow or improve?
Several big ones. The premiumization trend is a major opportunity to keep boosting margins. Expanding further into the health and wellness segment, non-alcoholic, low-alcohol functional drinks aligns with where consumers are heading.
Makes sense.
The digital transformation with the BES platform offers huge potential to deepen customer relationships, gain efficiency, and leverage data even more. And continued sustainability initiatives can enhance brand reputation and potentially attract environmentally conscious consumers and investors.
Right. Now for the external challenges, the threats. What keeps management up at night?
Number one is probably intense competition, mainly from Heineken, but also those nimble craft breweries. Then there's the complex regulatory environment. The constant threat of higher taxes or stricter rules is always lurking.
Taxes are a big one for beverages.
Huge. Also, shifting consumer tastes in the long run if people move away from beer and sugary drinks faster than expected. And underpinning everything is economic volatility, recessions, high inflation, political instability in their key markets directly impacting consumer spending power.
You mentioned inflation and interest rates as macroeconomic factors. How specifically do those impact Ambev right now in places like Brazil? Is that the biggest threat?
It's arguably the most immediate and significant threat, yes. High inflation hits them in two ways. It erodes consumer purchasing power, meaning people might buy less or cheaper drinks, and it increases Ambev's own local operating costs.
And the high interest rates used to fight inflation.
Those act like a brake on the whole economy, further dampening consumer spending. We're seeing consumer surveys in Brazil showing fragile sentiment, even with a decent job market. People might trade down or just cut back. So prolonged high inflation and rates definitely mean weaker potential sales and ongoing pressure on margins.
Okay, that's a clear and present danger. What about geopolitics? You mentioned the complex landscape. How might something like, say, hypothetical new U.S. tariffs on Brazilian goods in 2025 affect Ambev?
Well, the broader geopolitical landscape in the region is inherently complex. Political swings, corruption issues, crime, it all creates uncertainty.
Right.
In a specific scenario like new U.S. tariffs on Brazil, the direct impact might be less on Ambev's own exports-imports, but the indirect effect could be significant. Tariffs could trigger a depreciation of the Brazilian real against the dollar.
Worsening that currency mismatch again.
Exactly. It would inflate the cost of all their U.S. dollar-denominated inputs, aluminum, barley, maybe leading to that commodity squeeze on their profit margins. Plus, rising Chinese influence in the region adds another layer of geopolitical uncertainty to navigate long-term.
Complex indeed. Okay, we've journeyed through pretty much every facet of Ambev, from the beer itself to geopolitics. Now let's bring it all together. Let's synthesize the investment thesis for you, the listener.
Chapter 7, Conclusion. Synthesizing the investment thesis.
Let's start with the bull case. What are the key points arguing for investing in Ambev?
The investment thesis here is really rooted in classic value investing principles. First and foremost, the wide and durable economic moat. That comes from market dominance, iconic brands, huge-scale economies, and that unmatched distribution network. This moat allows for high, stable returns on capital over time.
Okay, the moat, what else?
Second, exceptional financial strength. They are incredibly profitable, generate vast and growing free cash flow, and have that pristine balance sheet with minimal debt and lots of cash. This gives them resilience and flexibility.
Management.
Third, proven and disciplined management. They have a long track record of operational excellence, smart capital allocation, improving margins, and consistently returning capital to shareholders.
Shareholder returns themselves.
Fourth, attractive shareholder returns, delivered through that generous mandated dividend policy and those opportunistic share buybacks.
And finally, valuation.
And fifth, a reasonable valuation. As we discussed, the stock appears to trade at a reasonable, possibly even discounted level, likely because the market is applying a significant country risk premium due to its Latin American focus.
Okay, that's a compelling bull case. Strong moat, financials, management, returns, and valuation. Now the bear case. What are the main arguments against investing or the biggest risks?
Interestingly, the primary risks are almost entirely external to the company's operations itself.
Macro and geopolitical.
Exactly. Number one is macroeconomic and geopolitical risk. Heavy concentration in Latin America, especially Brazil, exposes them significantly to economic volatility, high inflation, currency swings, political instability. It's the biggest overhang.
What else?
Second, that related issue of margin pressure from currency and commodities. That structural currency mismatch is an ongoing risk. A weaker, real, or spikes in commodity prices can directly compress profitability.
The consumer.
Third, the fragile consumer environment. High inflation and interest rates squeeze disposable income, potentially leading to lower volumes or consumers trading down to cheaper alternatives.
Regulation.
Fourth, regulatory uncertainty. The persistent threat of new or increased taxes on alcohol or sugary drinks is always there.
And the ownership structure.
And fifth, that controlling shareholder dynamic. The potential for AB InBevs needs to influence strategic or capital allocation decisions in ways that might not perfectly align with minority shareholders' interests.
Okay, so the risks are mainly external, but they are significant and real. Let's quickly summarize the valuation picture again.
Sure. Just to reiterate, based on that conservative educational DCF model, the estimated intrinsic value range for ABEV on the NYSE was US $2.80 to US $3.22 per share. Comparing that to the current price of US $2.42 as of July 18, 2025, it suggests the stock is trading at a notable discount to that estimated intrinsic value.
So wrapping this all up, what does it mean for you, the listener? It seems like we have a clear dichotomy here, don't we? An exceptionally high-quality business operating in what can be a high-risk environment.
That's exactly it. The company's internal strengths, the moat, the financials, the execution are undeniable. But the external threats from the macro and geopolitical landscape in Latin America are equally real and significant.
How should a long-term investor think about this?
Well, if we connect this to the bigger picture, for the patient long-term value investor, the current market price appears to offer a compelling margin of safety. It seems the market is heavily focused on those short-term uncertainties, maybe undervaluing the long-term, durable, cash-generating power of this beverage behemoth.
So potentially an opportunity for those willing to ride out the volatility.
Potentially, yes. While the path ahead might be choppy due to those external factors, the fundamental quality of the underlying business is hard to deny. For investors willing to look past the near-term headwinds, Ambev could represent an attractive opportunity to own a truly world-class business at what looks like a discounted price.
Which brings us to a final thought for you to ponder. This really raises an important question, doesn't it? How do you weigh that undeniable quality, that deep economic moat, against the inherent, often unpredictable volatility of an entire region? What stands out to you most about this balance between business strength and environmental risk?
Something to definitely think about.
Indeed. Well, if you enjoyed this deep dive in that final question, remember to like and subscribe to the Stock Analytics AI YouTube channel for more. We really hope this has given you a truly informed perspective on Ambev SA.
And just a reminder, this analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice. Please, always do your own research or consult with a qualified financial advisor before making any investment decisions.
That's crucial.
And as always, the work cited for this deep dive is extensive and detailed if you want to dig even deeper yourself.
Absolutely. Until next time, keep digging, keep learning, and stay well informed.